This is Mark Hill, the Traveling NP. I've decided my next topic will be taxes, taxation, financial issues that I've dealt with. Please understand that I am not a tax professional, nor do I play one on TV. So this is not tax advice. This is discussing the things that I do in regards to my taxes and how I handle my tax business. As most locums people know, there are two types of contracts. There are W-2 contracts where you actually work for the locum tenens company as a staffing agency, and you get a W-2 form from them. And then then the other way is the private contractor way, where you get a 1099 from them and they pay you a flat rate, plus they'll give you tax-free stipends depending on what you're doing and how you arrange that with your company, for travel reimbursement and or living stipends. Now, what I have done personally is I have set up what's called a S corporation, which is I have made myself a company and registered it with the state and with the IRS. And what an S corporation is it is a flow-through entity. In other words, when I get paid, most of the business that I have done has been through 1099, although I have had a little bit of business that was done on W-2 form that gets taxed prior to coming to me. Most of what I've done is 1099 as a private contractor, which means the companies that I work for, the staffing agencies that I staff for, they send a paycheck, a reimbursement check, to my business account. And that business account is set up in a fashion to where I can distribute those funds. I have a credit card that I use, or a debit card, and I use that debit card to pay for my expenses. For example, if I'm at a place that, like on this next assignment, where I'm not getting reimbursed my gas and my living arrangements, I will take all the cost of my living and my fuel cost and my food cost off as expenses. And that comes off the top to where I don't pay taxes on any of that. Now, if I get reimbursed tax-free money for living stipend and or fuel, then you can't. So you have to be careful about what you're taking off and what you're not. Some jobs I do pay a stipend, some don't. Sometimes I have an all-inclusive rate to where I get paid more per hour, and then I take off all my expenses on my S corporation. Now, food is always expendable. I think right now the going rate is $51 a day for an individual that you can allot for food expenses. Now, what this does is with this S corporation, you're required by law to pay yourself a reasonable salary. Now, there is no specific amount that you have to pay yourself. What I typically pay myself per year in salary is around $60,000 a year. The money that's left over after I pay my expenses, I take out as what's called an owner draw. And that owner draw, if it's set up through the S corporation, you don't have to pay 7.25 of your self-employment taxes. As a self-employed LLC, if you don't file an S corporation, you have to file your portion of self-employment taxes, and you have to file your former employer's self-employment taxes, which total up to around 15%. The numbers have changed a little bit. But as an S corporation, I only had to pay self-employment taxes on what I pay myself in salary, which is a reasonable salary. Everything above that I take out as owner draw, I don't have to pay self-employment taxes on that, which comes out to be about 7.25% of all of that money. I still have to pay the employer's portion of that, 15%, but I don't have to pay the total employee portion of that as well. So, for example, if I were to make $250,000 a year, and after expenses, all my expenses were paid, I profited in my business $160,000, and I paid myself in salary $60,000, which is a reasonable salary for a nurse practitioner. Then I could take out $100,000 as owner draw, which means that money still comes to me, goes into my personal bank account. The difference is I'm going to save myself $7,250 on that $100,000 that I don't have to pay in taxes. Now I have to pay all the employment taxes on the first $60,000 of salary. That's required by law. When I take out the draws every year, I only have to pay 7.25% of my self-employment taxes instead of the total 15%. It makes up a lot of money at the end of the year, especially if your owner draws are high. Now, the other benefit of an S corporation is this. At the end of the year, I can set up what's called an I-401k, or an individual or self-401k plan. What this allows me to do by law is, right off the bat, no matter what I make, up to 100% of what I make, I can put $18,000 into a 401k plan that I established through a bank. I don't have to put it through a brokerage. I can just go to the bank and say, I want to open a 401k plan with my own money and put it in it. And you have to register it with the IRS. Then, because I'm older than 50 years old, I could add another $6,000 to that $18,000 self 401k plan as an employee of my business, because after the age of 50, you can add what's called a catch-up amount to that $18,000 for a total of $24,000 that can go into that 401k plan tax-free. Okay? And then, because I'm also the employer in my business, I can contribute into that 401k plan up to 25% of my salary. So, if I pay myself $60,000 a year, I could put $18,000 plus $6,000, which is $24,000, into that account, and then 25% of $60,000 is another $15,000, which adds up to be $49,000 that I can put into that 401k plan, that individual I-401k, completely legal, into an account at the bank that I can use to invest in real estate, or I can put it into mutual funds, all those things, or I can just let it sit there and accumulate year after year after year, or put it into CDs, whatever I want to invest it in, but it's tax-free money. Now, you cannot use that money. If you can take a loan out on that money, but you have to pay that loan back with interest, the IRS is going to be keeping track of that account. If you start sneaking money out of the account, you're going to get audited and you're going to get busted. You have to put money in there and either leave it in there or put it in as investment. Let's say you invest in real estate. Let's say you buy a house and you're going to rent it out. You can do that. Buy a house, you're going to rent it out. But every rent check that you get from your renters has to go back into that self 401k plan, and you can't touch it. If you do, you're going to be in trouble. You can run your own 401k in a bank account of your choosing, as long as it's set up the legal way and it's registered with the IRS. You do not have to go through a broker. You can write a check for $50,000 to a mutual fund if you want to, but all the dividends from that mutual fund that ever gets paid out has to go back into that self 401k plan. Now, when that 401k plan gets to $250,000 total amount, you have to file more paperwork with the IRS, because they want to know when that thing grows to a certain degree. So there are a lot of advantages to being a self-employed person. A self 401k plan is imperative. You can put a lot of money into a self 401k. The maximum amount you can put in every year as a self-employed person is $54,000, and I think maybe it's gone up to $55,000 this year. Usually every year it creeps up a little bit for cost of living. But you can put up to $54,000 to $55,000 maximum per year for you and your spouse. Your spouse can actually be a part of your company, and you can contribute to the 401k for them. And you can hide from taxes that money. It's not hiding. The IRS knows all about it. They know you got that money. They know that that's set aside for retirement, but you cannot use it. Now, that has to be done by December 31st of every year, or it doesn't count. So you've got to have that money in there, sitting in there, being left alone by December 31st at the end of every year. You can put it in there a little bit along, or you can dump a big lump sum in at the end of the year and call it a self 401k plan. Then every year, contribute to that, or you could technically just leave it there and not do anything with it. Now, it'd be kind of dumb not to invest your money in real estate or mutual funds or something like that to get a return on it. Even if you put it in a CD, you're only going to get about 2% interest. Mutual funds, I think, are running about 8%. So there's a lot of financial advantages to being your own company and having an S corporation. Even if you have an LLC, if you have an LLC and you're a sole proprietor or an LLC, you have to be an LLC to file for an S corporation. So you can file as an S corporation with an LLC. So you don't have to change from an LLC to an S corp, but you can file as an S corp with an LLC. There's a lot of tax advantages. An S corporation is simply a flow-through entity. It allows you to receive monies from the work that you do, and then pay yourself a salary, and then give yourself owner draws at a lower self-employment tax rate, which saves you a bunch of money. Even if you owner draw $50,000, that's still $3,500 in tax savings at the end of the year. Plus, if you leave money in that business account at the end of the year and you decide, hey, I don't need all this money as income and I don't need it as a tax draw, you can dump a lot of that into a self 401k plan and never get taxed on it at all. At least not until you're 59 and a half. And you can still contribute to Roth IRAs and regular IRAs. So there's all kinds of things that you can do with your money. There's all kinds of tax benefits for being a self-employed person. And there's all kinds of ways to deduct your expenses. When I'm on the road, my family travels with me. We basically eat tax-free. Pay for all our food, everything comes off the top, because I can allot myself $51 a day, 7 days a week when I'm on the road. Well, I can buy groceries for that, feed my family. My truck gets full fuel. A lot of times I won't even take jobs that pay me a stipend. I just ask for an increased hourly rate so that I can take all the expenses off my taxes. So if I pull in $250,000 in a year and I have $75,000 worth of expenses, that means I've technically my business has only profited $175,000. Then I pay myself $60,000. I dump a bunch of money into a self 401k plan that I don't get taxed on at all, and then I take out the rest as draws. So my income doesn't necessarily, according to the IRS, it doesn't reflect what my business really did. It only reflects what I pay myself in salary and then what I pay myself in owner draws, other than what I'm not going to put into a self 401k plan. Anyway, do your research. That's how I started. Get on YouTube, research S corporations, research self 401k plans or I-401ks. There's a plethora of information out there for you. It's available. You can use it. It's all completely legal. Saves yourself a lot of money. You're giving the government money if you don't file an S corporation, and Lord knows they don't need your money. So pay attention, do your research, and you can figure out how to best. Now, remember, you got to pay quarterly taxes. So at the end of every 3 months, or 15th of every 3 months, like I just sent a big check into the IRS for June the 15th. Let's see, January, February, March. April, May, June. By June the 20th, I had a big IRS check that I sent in. They give you a little calculation thing. And so I had to send the IRS a big check. Here at the middle of September, I've got to send in another big check to the IRS. You're going to be paying your quarterly taxes. And it's likely, if I don't dump money into a self 401k plan at the end of the year, I'm going to have to pay a lot of taxes towards the end of the year as well. So if I've got a bunch of extra money left over, I'm not want to pay taxes on that. So I'm going to dump as much as I can, what's legal, into a self 401k plan and pay taxes on the rest. And then I just let that sit there, or I invest it however I want to do it. But you save a ton of money on taxes. Do your research. Look up these things. Be wise. Be smart. Hey, you're smart. You're a nurse practitioner. As far as I'm concerned, you're one of the smartest people in the world. Thanks a lot. This is Mark Hill signing out. Till next time. See you later.